Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, February 21, 2018. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And it was quite an interesting day out in the markets today. There was about a 50-point swing from today's high to today's low in the S&P 500. That translates to about a $5 swing in the SPDRs. The SPDRs made a high today of 274.72. We finished the day at 269.97. The reason I bring that up is it's a reversal day. We finished below the 50 and the 20-period moving average, having been back above both of those earlier in the session. This is an important development, and you can see where we finished the day, pretty much right on top of, very close to the first support level at 269.72. Today's low comes in at 269.94. That's pretty much within a couple or 3 pennies of where we closed the day. So we were up earlier in the day, and they sold them into the close, and it's all important on how they close them, not necessarily how they trade during the session, but what's important is how they close them, because that gives you an indication of what traders are thinking going into the following trading day. So all in all, this market is pretty much playing out just as we designed it several days ago. We had the up move, and the up move went right into, or very close to, within pennies of the 275.50 level. We've been pulling back. We made a test or attempt at that level earlier today and failed. You can consider that a lower high, and then we had quite the sell-off from that lower high. As far as the media is concerned, the catalyst will be the Fed minutes. The Fed minutes were released, and this is the minutes from the last Fed meeting that existed. So what they do is they clean up the minutes and they put out what they want you to think they talked about, and that becomes the minutes of record. So these are the FOMC minutes from the last meeting. The reason that I say it'll be the catalyst is because the market sold off, not necessarily right after the Fed minutes. In fact, after the Fed minutes, the market went up. Here's a 10-minute chart, and you can see here the Fed minutes get released at 2 o'clock in the afternoon. That's 1400 hours. And the following candle was a big up candle. So the 10 minutes, 15 or 20 minutes, and 30 minutes following the Fed meeting, the market was up, and then the market rolled over. Irregardless, that will be the catalyst or the blame for the rollover. It'll be the Fed minutes. It really makes no difference at all. It doesn't matter one bit. What matters is where we closed them today, and where we closed them is right above our first support level at 269.72. I'm going to go over to an hourly chart, and I'm going to show you something also very interesting. So here's your lower high. So what we had is the high from the other day where we tested the 275.50, came up just pennies short. Then we rolled over. Now we had another attempt and we made a lower high. That's a bearish signal. And where did we come today? Right into the 100-period moving average on the hourly chart. There's also a convergence of the 100-period and 50-period, which is the blue trend line, moving averages. So those are converging. That also happens to be the same zone of the 269.72 where we've discussed the first support level back on the way down. So it did make sense, at least from an intraday perspective, albeit late in the day, that's where the market found first support or support intraday towards the end of the trading session. Another interesting piece of information, and those of you that have taken the Lazy E-mini Trader course will know this one. So from the recent pivot low to the last pivot high that we had this afternoon, there's a certain amount of time that took place for that to happen, and that is very, very important, and it happens over and over and over again, and anybody that's taken that course is well aware of what I'm talking about. We made a lower high, and we went up for a certain period of time, made that secondary high, and the market rolled over. The reason I bring this up is because if you know what you're looking for on the charts, then virtually nothing will surprise you. And what I can tell you is that those that are used to hopping on board when the market's going up, those are the traders and investors that really got the short end of the stick today, because I can tell you that they were buying into that momentum upward as the market was turning over. There's also what's called a symmetrical move that took place right in here to here. And those of you that have taken the course know exactly what I'm talking about. So the fact that the market went up for a certain amount of hours, the fact that there was a symmetrical move, and the fact that we were coming very close to what I'll call a double top, at least on the hourly chart, that would tell us that the market was more likely to stall out at that point in time or at that specific price level or near-term price level than it was to just blow through it and continue higher. These are all bits and pieces of important information on how we're able to read the charts. The charts are always telling us something. The question is, are we able to put together the pieces to the puzzle that the chart is trying to tell us and get a clear picture? Do we have enough evidence? Do we have enough clues? The chart is always telling us something. The chart is always going to indicate what the next likely scenario is, where the resistance is, where the support is. The question is, are we able to decipher it? And that's part and parcel to everything that's taught in the course at Lazy E-mini Trader. All right, so we'll go back to the daily chart, and what we'll do is we'll take a look at what the two possible scenarios are. And what we have here is, even though the market finished poorly on close today, this is still, even though it was a reversal day, there's still another side to the coin. There's always two sides to the coin. We always have to look to see, is there a bullish setup and is there a bearish setup? So we talked about the bearish setup. We talked about the reversal, the lower high, closing below the moving averages. So is there a bullish setup is the next question. And really, there still is. So we had the up move, and technically speaking, this is still a bullish pullback pattern. So can we go up from this level? Yes, we can. Do I think that's going to happen? I think that's less probable. It's possible. It's just less probable. Do I think we're going to come down to the secondary level and maybe even to third support? Yeah, that's what I think is happening. So I think that at a bare minimum, I think we're coming down to retest this former breakout area. That puts the S&P or the SPY down at the middle support level at 266.76, give or take 25 or so cents in the spiders. That's where I think we're headed. Could we break lower and come down to the 100 period moving average as low as 264? We absolutely can. In the big scheme of things, it's not that much lower than the second support level. And either way, again, my opinion is, from this stage of the game, I don't think we're going, at this point in time, down to retest the lows. I think this is a pullback, and I think that from one of those two levels, the market does rally. Now, that's a little premature to say. We have to take it one day at a time. We have to see how the market treats these levels, but I will be looking for signs and a signal of a market reversal at one of those two levels. Either one. I don't care which one it is. It doesn't make a difference, because my opinion is, and I don't want to interject too many opinions into the market analysis, but based on how the market gets down to one of those levels, and based on what happens at those levels, I'm looking for some long trade opportunities. Now, if we start closing below the 100 period moving average, and we close below the important level of 264, for example, then I have to say that we're more likely going to go down and test double bottom from the low made a couple of weeks ago down here. But I'm not ready to just make that assumption just yet. I want to see how the market treats the support levels that I've identified, so we will take it from this point forward one day at a time. Now, we're looking over at the IWM, or the Russell 2000 index, and what's interesting is the IWM finished flat today, but you can see how we were up much, much more earlier in the day. In fact, the Russell 2000, or the IWM, was the strong horse today. We were all the way up here. We finished the days near the low, and I think from high to low, it was about a $2.50 some odd cent, maybe $2.60 pullback from high to low in the IWM. That's another reversal, and the chart looks very similar to the spider chart. We had a reversal. We did make it a high, a higher high, not a lower high in the IWM. I thought that was interesting. So right up here where I put this line in, that's a higher high. Remember, the spider chart was a lower high and we failed. I'm not exactly sure if that's going to be anything of significance just yet, but I think it's interesting nonetheless. We are below the moving averages, both the 20 and the 50. We're above the 100. And all in all, when you just pull back the curtain a little bit and look at this from a bird's eye view, there's really nothing wrong with the IWM. Here's an up move, and we're really just consolidating above the 100 period moving average. So there's technically nothing wrong, and this can certainly go higher. But again, if the spider sells off much more and the IWM comes down farther and we start closing below the 100 period moving average, there could be some more downside in the IWM. But right here, right now, this market is telling me that these markets are not going down to at least test or make new lows from the lows made all the way back on February 9th. So if I'm getting any indication or reading from the IWM, although it was a reversal today from high to low, and it was a pretty ugly one at that played out in just a couple of hours of trading, even less than that, what I can tell you is that the IWM is telling me, just by visually looking at the chart and looking at the pattern that's developing, that this market is not breaking down. This market is setting up to go higher, and it's going to be very interesting to see. And I think all this is going to take place, a test of the support levels discussed in the spider or the S&P 500. I think all this is going to take place over the next 2, 3, 4 trading days. I don't think we're weeks away. I think this is imminent. I think this is happening right here, right now. Whether it's tomorrow, Friday, Monday, something in that neighborhood is when I think this is going to happen. And I'm going to be looking for signals on how the market treats those levels from the on the downside, and whether it puts in signals of a reversal, signals of a trend change, anything of the sort, because I think there's a trade here on the long side, but it's a little early to tell that. It's just my indication. It's what the IWM or the Russell 2000 market is telling me right now. The transports. Now, the transports actually finished up today, but they were up a tremendous amount, and you can see they also had, from high to low, a pretty good sell-off today. And yet again, the transports were still not able to. They challenged it one more time, but still not able to get above, certainly on a closing basis, that high from the breakdown candle. That's important, and that most likely has lower prices in store for the transports. Again, I don't think we're going to bust through these lows from the 9th of February. It remains to be an open mystery. It's really all going to depend on the S&P 500 and what it's doing. Now, the transports certainly are my second favorite market leading indicator, but the fact that the transports actually still finished positive today, still finished or were able to eke out a small gain of 1/3% in a market that rolled over pretty poorly in the afternoon, it's just not telling me that these markets are going to go and make new lows right here, right now. What happens later in the year, that's fine. But right here, right now, that's not the indication that I'm getting from any of these markets that I look at and read. The gold market, still showing weakness. Gold tried to rally after the Fed meeting, but what happened really was that the dollar started selling off, gold was rallying, and then the dollar flipped the switch, and the dollar rallied, and gold sold off, and gold is weak, but the numbers don't change. The important level in gold is going to be 1319.10. As long as we can stay above this level on a daily chart closing basis, then this is still, technically speaking, a bullish pattern and nothing is wrong. If we close a day below that level, then look out below. There are lower prices coming in the gold market, most likely. So I'm watching very closely. I'm not long or short gold. I'm just analyzing the chart, and telling you what I see. And right here, right now, there is no long or short trade. Intraday traders may choose to take a trade at the 1319 level if and when we do get there. But until and unless I see us either hold that level on a daily chart closing basis, then it will be a bullish sign. Or if we close below it, that's going to be a bearish sign. But there certainly are support levels along the way. But that will tell me that lower prices are coming in gold. Crude oil was weak today. Crude was down about 70 cents, a little over 1%. But really, there's nothing technically wrong with this chart. It had a nice big rally off the 58.25 level. We went all the way up. We discussed it yesterday. Came just short of the 20-period moving average. So it would be normal garden variety market behavior for us to work off some of the short-term overbought condition and just pull back, consolidate a little bit. We can pull back further, and then they can set up for another move higher. The only thing that would be negative at this point in time for crude oil would be a close below these lows. As long as we stay above on a daily chart closing basis, above those lows, then crude oil is still in a relatively bullish position. And when you look at the longer term chart, we might as well look at it here. Well, that's a monthly. I wanted to look at the weekly chart. You can see here, we had a pretty ugly week last week, but we're still above the 20-week moving average. And this is still technically in a bullish position that I still contend can get all the way up to $73.78. That's an exact price target from a mathematical perspective. Could be 74, could be 74.25, could be 73.5. But that's the general zone. The 200-period moving average on the weekly chart wouldn't necessarily provide a tremendous amount of resistance at this stage because we came close to it, backed off. What the market is doing here is the fact that we went up and we backed off of that level. The market is essentially pulling back, building some energy for another move higher. That secondary move higher would not necessarily be thwarted so much by the 200-period moving average because we came so close to it already. It changes the significance of what normally is a very good resistance point. What this setup is telling me, if we did have a secondary move higher, is it really wouldn't be much of a resistance point, and I think we would go all the way up into the 70s. And that's now, before I wrap it up, I just want to show you, since I discussed it earlier, talk about the dollar. That's the weekly chart, but wait till you see this. So the dollar is still trying, and I haven't talked about the dollar in the last several sessions, but the dollar put in a low here. We had the tail low. We tested it. We went up. We came back, and we back tested it, but we did not close below that level. And now we had 3 nice, healthy up days, and I think this is the dollar's way of putting in a bottom. I think there are higher prices coming over the long term in the dollar. You know how I feel about the dollar. If you've been watching these videos for any significant portion of time, then you know that what I've been saying about the dollar, I said 88 cents on the dollar, give or take, is likely to be a bottom, and that should be it, and that should promote a long-term rally in the dollar from those levels. But it takes time. When you look at like a weekly chart or even a monthly chart, these things take time. We made it down to 88 cents on the dollar. When you look at a monthly chart, here's your level that I was looking at. You broke out above this level. That's a breakout. You came back to test a former breakout area. Really don't have to look at it any other way than that. We tested or came very close to the 100-period, the 100-month moving average on the dollar. We didn't quite hit it, but that's a very close attempt at the 100-month moving average. And here we are trying to rally away from that level. Look at this chart. Here's a monthly chart that was well over 100 cents on the dollar, and it took, about a year and a half to come all the way down to where we are now. So these things take time. This isn't going to happen in the next 2 weeks. We're not going to go up to 95 or 98 cents on the dollar in a couple of weeks. There are a lot of resistance points along the way. But all I wanted to point out is, what I've been saying for quite some time is, the dollar is in a long-term test of a breakout area, and I still think it's a bottoming process when you look at the daily chart. And therefore, I think the lows are in for a while in the dollar. Doesn't mean we're not going to have down days, doesn't mean we're not going to have down weeks, but over the long term, higher prices are likely coming in the dollar. And with that, it's everything I wanted to and intended to discuss tonight, so I'm going to give it a wrap here. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.